Most people think banks reject loans because of collateral. That's not true. From a banking perspective, most loan decisions are made within minutes, and they are based on one thing: risk. If you don't understand how that risk is evaluated, your application will keep getting rejected. I'm going to break this down from a real banking perspective, how credit officers actually think when your application lands on their desk. Not theory, not motivation. This is decision logic. Every loan decision comes down to three things: capacity, structure, visibility. If you fail in any one of these, your loan becomes weak. Let's break it down. The first thing banks check is simple. Can you repay this loan? Not, do you want to repay? Not, do you promise to repay? Can your income actually carry the loan? If your business or salary cannot clearly generate enough cash flow to cover repayments, the application is already at risk. Here's the truth most people don't understand. Collateral does not replace cash flow. Banks are not looking for what happens if you fail. They are looking at how you won't fail. Example, if you take a loan of 50,000 Ghanaian cedis, the bank wants to see where the repayment is coming from, how consistent that income is, whether it can absorb shocks. If your numbers don't make sense, the decision becomes easy: reject. The second thing banks check is, do you understand your own loan? This is where most people fail. If you cannot clearly explain what the loan will be used for, how it will generate value, how that value leads to repayment, you signal risk immediately. From a credit perspective, confusion equals danger. Example, two applicants request the same loan. One says, I need money for business. The other says, I will use this loan to buy inventory that turns over every 30 days, generating X profit, from which I repay monthly. Guess who gets approved? The bank is not funding ideas. It is funding structured cash flow systems. The third factor is, can the bank see your financial reality clearly? No records equals no trust. If your income is unclear, expenses are not tracked, business has no proper documentation, you are automatically classified as high risk. From a bank's perspective, if we cannot see it, we cannot trust it. If we cannot trust it, we cannot fund it. This is why many SMEs struggle to access credit. Let me give you the real insight. Banks don't reject people, they reject uncertainty. When your application lacks clarity, structure, and strong cash flow, it creates uncertainty. And uncertainty is risk, and risk gets rejected. If you want to improve your chances of approval, focus on these three. Strengthen your cash flow. Increase consistent income. Reduce unstable revenue sources. Structure your loan clearly. Define purpose. Define repayment logic. Improve your records. Track income and expenses. Document your business properly. When these three align, your approval chances increase significantly. Before you apply for your next loan, ask yourself, can my income carry this loan? Can I clearly explain how it will be used and repaid? Can the bank see and trust my numbers? If the answer is no, fix that first. If you want to understand how banks really think and position yourself to win, subscribe to LoanLogic Ghana. This is where you learn the system behind financial decisions.